There was a question, it seemed. Are they spending too much? You know, will the revenues come? And now it feels like the market is totally down with as much capex as they can put out there because we're supply constrained, really, according to Mandeep Singh. So how do you look at it?
Yeah, I think there's been a massive rally over the past couple of weeks over really anything that the AI wand touches, and the reports that we're getting this week are going to have to justify a lot of that move. So that is a high bar, and I think that's more of my concern there is more of a short-term trade move. Over the longer term, strategically, I think that as long as this capex keeps going and the market keeps rewarding that, it'll be great. My concern is that at some point it's going to decelerate, and I think that could pretty substantially change the AI story.
So where do you see that hitting specifically? I'm thinking about 85% earnings growth for NVIDIA. I guess you could decelerate a little bit from that because it's such a huge number. But a lot of other companies, we mentioned the cash burn at Amazon. We mentioned low expectations for Meta EPS growth, negative expectations for Alphabet EPS growth. They're spending so much that their earnings growth can't decelerate anymore.
That's true. And I also think we're going to start to see a little bit more idiosyncratic behavior. We just had an announcement this morning of the changing nature of Microsoft and OpenAI's relationship. And it's strange to say it for a massive company like Microsoft, but this is a relatively new industry, sort of almost in its infancy. So there are a lot of changes going on. And I think going forward, we're going to see a lot more of people sussing out the winners and losers and who's best positioned. And that's a little bit different than what we had for a lot of the past couple years, which was the sort of monolith moving all as one.
Do you not see at least the hyperscalers still as one monolith?
I think for now they are. If you start to have a slightly less aggressive growth environment on the capex side, I think they'll diverge more.
In terms of the market moves, you know, it's fascinating that President Trump's Truth Social posts have driven the biggest moves in this market. Probably not a surprise if you're following along every day. But does that matter longer term, or is that just a trading opportunity for those in the know?
I think that's trading opportunity. It's something that's so difficult to predict any one individual's behavior that it's sort of a game that I wouldn't want to play, as you mentioned, if you're in the know, maybe. But it's more about playing the longer-term trends. AI, of course, has been a major story, and I think what's going on in Iran, of course, also has some longer-term implications.
But it seems like for the now, the Iran war, the closure of the Straits of Hormuz, the doubling of the price of oil has had almost zero effect on strategists' earnings expectations.
Absolutely. And pretty much everywhere you look in the market, they're telling you nothing to see here. Stock prices moved a little bit, but they've come back. Spreads are still narrow. And energy prices, especially further out on the future curve, are basically pricing in a return to normalcy. And our base case is for a continued trend towards becoming less aggressive on the Iran situation, but trend is the key word there. I don't think the de-escalation can be very smooth, and also it's not going to be like you can return to the Strait of Hormuz as it was before the conflict. The Bab el-Mandeb Strait has been in the news a little bit as a potential what could go worse from here, but it also offers a historical example of what can happen if things get a little bit more resolved from here. That strait, it's another oil choke point. Back in 2023, it started to go under some attacks from the Houthis, and that went on for a while, and you saw transmission through that choke point fall off a cliff. After a ceasefire was declared in that conflict, you did not see a return to normalcy. That stayed at almost like half the levels that you had seen before. So I think with the Strait of Hormuz reopening, it's not going to be a return to what it was before. There will be sort of this permanent risk premium priced in for the foreseeable future.
So does that, first of all, that's fascinating to use that as a template for what we might expect to see if the strait is reopened. Does that affect the slowdown in transmission through those two straits, really, your EPS forecast for the S&P at year end?
We see it as sort of a tax on economic activity. Energy prices will likely be higher, input costs also higher, but we see it sort of as we saw the tariff story, which is it's not causing entrenched inflation because hiring is so weak, it's hard for workers to see higher prices at the pump and go ask for a raise, so you don't get that wage price feedback loop. And at the same time, you have the AI story really helping companies become more productive and giving people a reason to invest in growth. But I think the energy story and the remaining tariff story will just continue to drag growth down at the margins.